Hey everyone, the streak is over. The oversold bounce finally lost steam today. I'm calling today the day of the fade. Let's take a look at the indexes real quick. S&P 500 down 0.8%, right back to the 50-day moving average. Of course, since I'm bullish, I'm hoping to look for a rebound from the support level. Maybe we get a hammer and then rebound on Monday. That's what Trader Mike suggested could happen. Let's take a look at the NASDAQ. You see a fade here, but it didn't get back to nearly the 50-day moving average support, down almost 1%, essentially 1%. The biggest fade was small caps with the iShares Russell 2000 ETF falling a whopping 1.6%, wiped out a lot of gains that it had at the last 2 days of last week. And now it's even back below this 20-day moving average downtrend. So this tells me that sentiment has yet again taken a sharp turn, but this time for the worse. This is going to have to stabilize at some point before I can trust in any kind of rebound from here. Now, I'm bringing up the fade because as I looked at earnings, I started noticing a bunch of stocks having good reactions and then sellers just swarming and smashing price from there. And it made me wonder how many stocks are out there. And I knew that Swingtradebot is a good way of finding these things. So this is a tutorial about how to use the combo scan for finding what I'm going to call post-earnings fades. And you can always, when things are bullish again, you can also use this to look for post-earnings fades to the positive or to the upside. But I'm going to focus on downside because of the sentiment shift that we saw. I'm going to go really quickly. I know I promise this all the time in these videos, and I don't do it because there's so much to learn, so much to see, but I promise I'm only going to show a few examples. So once again, reminder that I am a subscriber to Swingtradebot, so some of the things you see here may not be available in the free version. Okay, so let's go to end of day scans. There's something called the combo scan. It's a very powerful feature because it allows you to string multiple scans together. So the first thing I want to do is find the earnings movers, what's called the earnings movers in Swingtradebot. And then the second thing I'm going to look for are those stocks that gapped up. And this is where I feel like the bearishness is really evident when a stock gaps up higher after earnings, but then ends the day in a negative territory. So that's my second scan. Now, unfortunately, there's not a third scan for positive or negative gains. So I'm just going to do a workaround, which is to just sort the resulting stocks. So it's too easy to find these today because today was a day of the fade. So let's go, today is November 9th. So let's go to the 8th of November and look for the candidate stocks. And what's particularly powerful about going before it was clear that a bearish turn had happened in the market is that some of these stocks could be indicators, and stocks that have this kind of behavior when the market's still strong are particularly, you should consider them particularly vulnerable. Okay, so now I click on find stocks, and let's see what kind of candidates we have. I like to first go down, wow, have a lot of candidate stocks, 3 pages worth. So let's just go through a few and see whether the this method works. So I now sort by price change, and this is the price change on the day that I selected, so November 8th. So this is the day of earnings. So what you're seeing here is this stock, for instance, Sage, gapped up in response to earnings, but then ended the day significantly down. So let's take a look at the chart here first. And you can sort of see the bearish action. This is kind of a weird stock. I wouldn't have traded this one anyway. But again, this is just an example. Let me go to Trading View to get a better look at this so we can also just confirm the earnings. So you can see here, it's funny, well, it looks like earnings was actually on the 7th and not the 8th. So there is going to be some wiggle room here, but you still see the effect here, which is I'm going to assume that earnings was truly on the 8th. And you can see the gap up here was really a tiny, tiny gap. And then it just closed down on the day. So, It's not a powerful example, so let's keep looking down the list. So ODP, Office Depot, this gives us a very good look. And in fact, you can see how bearish this looks because it's broken back below the 50-day moving average, which is that red line. So let's go to TradingView to get an expansive view on what happened with earnings. So you can see here on the 8th, see, this is a much clearer view, and it's a stock that I would have traded. So you can see here that, sorry, let me point out with my cursor. This is the day before earnings, and you can see on the day of earnings, the stock opened higher here and then just went straight down. And the fact that it broke through the 50-day moving average just makes it bearish right away. And you can see why these kind of stocks might be of interest because there was follow through selling the next day. Sure, it's not a lot, 1.6%, but this shows the potential for this scan in terms of finding stocks that are weak. Think about it this way. If a stock gaps higher after earnings, there's a lot of optimism, but then if it closes down on the day, it suggests that the interested or motivated buyers have been exhausted or have dried up, leaving a vacuum that only sellers are going to fill. Don't know how long and how deep and that this will last, but that's the theory or the hypothesis that I'll be working on when I do this scan. So let's see if we can find one more. I'm going to look for a stock that's probably well known. Here we go, Rivian. And I know this one is right because I remember seeing the headlines about the positive bump from earnings, and then I looked and then it was down. So here's Rivian. You could clearly see the nice gap up here, and then it closed the day down. What did it close down? 2.4%. Now, interestingly, the follow through was very devastating. The vacuum that sellers filled was so wide that Rivian closed down almost 10% and even closed at a, what is this? Well, the last time it closed this low was late June. So let's call that a 4+ month low. Very powerful follow through. I can't do a representative sample, but to me, this is good enough to suggest, hey, this is something I might want to keep an eye on. Now, when I talked to Trader Mike, the creator of Swingtradebot, about this, he also took a look at another potential way of looking for these weak stocks, which is earnings movers that also had bearish engulfing patterns after the gap up. And let me just explain really quickly what bearish engulfing is. So bearish engulfing means generally that the stock opened higher than the previous day. And I like to look at it, it's even more powerful if it opens above the previous day's intraday high. And then it closes below the low of the previous day. And I like it even as a stronger signal when it closes below the intraday low of the previous day. So that's a pretty bad reversal for a stock. So if we have a stock that's an earnings mover and bearish engulfing, that is pretty bad trading action. So again, I'm choosing the November 8th, and let me do find stocks. And let's take a look. The list is very small, as you would expect, because this is a very powerfully bearish move. Cart is probably something that people have heard of. This is Instacart, otherwise known as Sugar Bear or Honey Bear or something I can't even remember. Sorry, Maplebear. And you can pretty much see here on Swingtradebot's chart, but I always like to go to TradingView because I have certain things set up here. So let's take a look at Maplebear. And this is the gap up was very small, but it still was a powerful indicator of the bad move today, which was a 10% drop. Pretty bad. And let's take a look at one more for the bearish. Oh, and I forgot to show the bearish engulfing action. So the bearish engulfing here is it opened, and sorry for my cursor, it's hard to see, but because of the price there. Let's zoom out here. Now you can see that better. So you can see just barely, but it still qualified. It opened above the previous day's close and it closed below the previous day's close. That made it a bearish engulfing move. And then let's look at one more, and Rivian qualified as well. That's interesting. And VCYT, that's a stock I don't know of, but I like this one as an example because it also combined a 50-day moving average breakdown. What was it? VCYT, sorry. Veracyte. And again, I'm just going to keep it zoomed in so you can see very, very clearly why this worked so powerfully. Here was the earnings was actually in after hours, and then the reaction the day after was to pop up. Notice another feature here. Not only did it open above the close, but it also opened well above the upper Bollinger Band, which means that the stock was already stretched. Another interesting feature is that buyers were pretty excited going into earnings, which of course sets people up for disappointment. So this strong rebound was riding the coattails of the oversold bounce. And even one day, what was this? Last week, it even closed above the upper Bollinger Band, which means it was very stretched going into earnings. So the excitement continued with a gap up after earnings, but then the sellers just wreaked havoc, took the stock down for 3.6%. And per the hypothesis that I'm working on, it means that this stock is left vulnerable to further selling. And sure enough, today was even worse selling, 7.3% down. One last feature of this particular stock trading pattern is that it broke down below the 50-day moving average, but bounced back up, giving some premature hope that this stock could hang in there. And instead it cratered and it finished, it finished filling in this gap. And now this gap is in trouble. Notice how very conveniently the close is right on 20-day moving average support. So this was a tutorial to show you how to both use the combo scan and also to look for stocks that are likely to exhibit continued weakness because the buyers have exhausted themselves over the excitement of earnings. The exhaustion comes from gapping up in response to earnings, and then sellers coming in and closing the stock down on the day is the demonstration. I don't want to say something as strong as proof, but it's the demonstration of the potential for further selling ahead. Hopefully that was helpful. Leave any comments below the video, or you should also subscribe if you're watching this on YouTube if you want to see more of these tutorials. And I have a blog, drduru.com/122, all one words. If you want to see my writings about the stock market. Take care. Thank you for checking in, and see you the next time on The Market Breadth.